Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles. And joining me today, of course, the mayor himself, Mr. Michael Becker.
Hey, Paul.
Michael, how are you?
Doing well. Get ready for Christmas.
You know, I got a little Christmas gift from my niece the other day over Thanksgiving. It was called a sinus infection.
I've been fighting it forever. So Paul sounds a little weird. That's what's going on.
So, yeah, I've been fighting that for the last week or two. So, but looking forward to the holidays. How's everything going in the SPI world these days? Good
year. We closed out our last deal. So I think we bought 8 deals, sold 3. So we're finishing the year about 4,500 units. So that's a good, successful year for a small shop like ours.
You guys have done very good. So sounds great, Michael. So let's finish up the end of the year with a couple different podcasts. In the podcast today, we have Jorg Mast. And Jorg is with JLL here in the Dallas-Fort Worth area. And Jorg has a little bit of a different perspective on multifamily because he has come from the builder-developer of multifamily in the past, and now he's in institutional sales for JLL. So I want to get to know a little bit more about Jorg, for one, but also to get a little bit of perspective from his background to help you understand a little bit more about not only workforce housing, but also institutional sales on multifamily properties. So I'm going to kick it over to Michael. Let's get going.
Yeah, so Jorg, appreciate you coming in. So maybe what I thought that you could do. Yeah, maybe give a quick little background on yourself. And as Paul mentioned, before you got into investment sales, you were doing development. So maybe kind of take a few moments and tell us a little bit about your background and what makes you an expert in multifamily here.
Well, first of all, I'm from Germany and came here in the mid-'90s and to get my MBA at Texas Christian University in Fort Worth. And met my wife, her name is Heidi, from Texas. So that obviously led to my life here in Dallas. And I have been in the real estate business since 2000, so almost 20 years, and started really initially as an urban mixed-use developer. I was able to partner up with a local developer, and he was working on a big project named Mockingbird Station.
That was one of the largest private developments in Dallas.
Well, and it was the first transit-oriented development in Texas, and it was completely privately funded. So I was lucky to be a part of that. It basically was a big shopping center with about 211 lofts on top of it, and then a big office component as well. There was a fourth future component, which was supposed to be a hotel. Unfortunately, that did not pan out because actually 9/11 killed that deal. And my initial background was really hotel and restaurants, and so that's how I was able to partner up with the local developer. So, and over the years, then, I started building more urban mixed-use stuff with retail and residential, but more and more into residential development. Initially, for sale housing with townhomes and condos. Obviously, in 2005 or 2006, that was a great market. I also bought a building in downtown Dallas, a 100-year-old residential building, the Kirby building.
Oh, yeah.
And was able to renovate that and sold it in 2010 to an institutional player, Berkshire Group. And it's kind of interesting because we just sold that building 8 years later, and I sold it for $15 million. We sold it for $30.
Wow.
So that kind of tells you what has happened here in the Dallas market with respect to residential development. So then, I moved on and basically started developing multifamily projects exclusively for rent, got out of the for sale housing market. And then, so basically one of the brokers here in Dallas brought me one of the buyers. So what happened was that I got to know him, and then he sold his company to JLL. So that's kind of, how I made the transition over to JLL. And we can talk about JLL a little bit later.
That's good. So when did you join up with JLL?
I've been at JLL a little bit more than 5 years, so I joined right in January of 2014.
Well, good. And then, so maybe, take a little bit of time to talk about kind of the platform at JLL and kind of what role you serve for them.
Well, initially I was attracted to JLL because I was familiar with the name and the brand from Europe. And also I liked the international flavor that came with the brand name. I always wanted to be more active internationally. It was always one of my objectives to bring European or international investors over to invest in real estate here in Texas or Dallas-Fort Worth for that matter. The problem was, I have not been successful in doing that because a lot of the people in Europe don't understand a multifamily market like Dallas-Fort Worth. Europeans, they understand the 24-hour gateway cities because that's kind of the way they live over there. Everything is a lot more dense and there's public transportation and all that stuff. But here, this is a car-driven city, kind of suburban in nature, spread out, and it's just it doesn't make much sense to an international investor.
That's good. Let's maybe talk a little bit about, we talk a lot about workforce housing here on the podcast, and that's predominantly what Paul focuses on. That's predominantly what I own or historically have owned. So we talk quite a bit about that, but we don't really talk too much about the institutional class or development, anything along those lines. So maybe from your perspective, you guys at JLL do both workforce housing and institutional. So maybe kind of in your words, maybe talk a little bit about some of the differences and how the two function, because they function pretty similar in a lot of ways, but there definitely are some differences between workforce housing and kind of the institutional grade. So maybe talk a little bit about that.
Well, first of all, we are trying to, at JLL, we're trying to expand our footprint in the workforce housing space. We have been, in this cycle, mainly been focused on institutional quality properties, especially new construction, because we had so many new developments come out of the ground. But moving forward, we really want to have a two-pronged approach where we really are a lot more active in both spaces.
Let me just ask a question, and maybe a dumb question. What's the difference between institutional and workforce housing? Can somebody explain that to me for somebody that doesn't know what that means?
Well, that's a very good question. First of all, I would consider everything that's new construction or brand new product is interesting to the institutions. There's some core money out there that is really interested in those kind of deals. Institutional quality, institutional appropriate product is also a matter of size. Sometimes the transaction size, my average transaction price is probably around $50 million. And so there's just certain transaction sizes that a private investor cannot touch. The other thing is obviously in vintage. Institutions are a little bit limited. I think they predominantly like newer stuff better. So they probably wouldn't touch a deal that was built in the 60s or 70s. There's some institutional players that are doing 80s stuff as a value-add play, but typically they like to be more 90s or 2000 plus. So that's, I think, probably one of the biggest differentiators.
And where's the institutional money? Where's that coming from?
Well, institutional money is typically coming from several sources. There's obviously insurance companies, there's pension funds, there's international capital, which is also, again, a combination of pension funds and other institutions that are overseas. But that's pretty much it. Then there's a whole other component, and that's more like the big private guys, big family offices or big private players. They are kind of quasi-institutional or they're kind of institutional in nature, but they kind of create their own funds, but they invest like an institutional player.
So maybe talk a little bit about kind of some of the differences between kind of more the private groups like mine versus kind of more the institutional. I mean, I think most people listen to podcasts obviously have either bought a deal or aspire to buy a deal or potentially invest passively in some of these deals, and they kind of are more familiar with the syndicated environment. So what differentiates from like a process standpoint? How do you interact with a group like SPI Advisory, like my group, versus a big institution or insurance company? What would the two differences be with your interaction with them?
Well, the institutional investor is a lot more structured, especially when it comes to the process. Then typically they have to find product for a certain bucket, which, there's the core bucket, there's the core plus bucket, the value add bucket. And that obviously is a function of, the return requirements. And I even sometimes it's interesting, one group that has a fund that is actually investing in product that's 60 years and older. But that's because they're located in New York and they like old buildings, But it's my point is it's very specific in terms of what kind of property types they're targeting. And then obviously it comes to the process. Institutions are not necessarily as nimble, so they have a tendency to compete in our marketing processes and stuff. It's sometimes it's harder to do something off market because they're just not quite as gunslingers as you guys can be, which is a pro and a con.
Sure.
Okay, and I like both.
Sure.
That's why we want to play in both areas. And then obviously when they actually end up getting a deal or winning a deal, then it's the process, the due diligence process. And obviously there's investment committees, and they're just all very diligent in terms of how to get a deal done. And our challenge is that we have the acquisition guy of an institutional player, and then he's basically our ambassador to the investment committee. So what our job is to give him as much ammunition to get the deal approved in the investment committee. And then we'll take it from there.
Is there any sort of like consistent things that they look for when they're making their decisions for, the investment committees vary dramatically in how they go through the process, or is there some like similarities across different groups as far as like they need to see certain things to make a decision?
Well, I think they're overall very similar. Some investment committees are a little bit more informal. Others are extremely formal. Typically, the acquisition director kind of comes up with a write-up, and then they typically meet once a week, typically on Monday. So basically, I think the acquisition guy just makes a case for the deal, describes the deal, what it is, why they should buy it, and obviously they have underwritten the deal and what kind of return expectations they think they will achieve.
Good. Okay. And then private guys like firms like mine, I mean, it's so all over the map with how they go about making decisions. Maybe kind of describe some of the variances that you've experienced across, firms similar to mine.
Well, Michael, the beauty of your position is you're your own boss. So you make your own decisions, and if you like a deal and you want to go after it, you're going to go after it.
Yeah.
And nobody really tells you what to do. As long as you can raise the money for it, or you have the money for it, it's your decision. You go. In the institutional world, that's not the case. There's a lot of people that have a say, and obviously there's a lot of window dressing sometimes, and it's just a little bit more red tape, political.
That's good. So maybe talk a little bit more to, we've talked a lot about kind of the institutions, but maybe talk a little bit more about the actual developers and kind of how they put those deals together, because those are a little bit different. I think we've been kind of just talking a little bit more about, already completed product and they just want to own it and operate the deal. What's driving these developers today, and kind of maybe talk a little bit about their kind of process to get a site selected and to, getting the buildings leased up and sold through you guys?
Well, developers are a little bit like a recovering alcoholic, so you get them back on the sauce, so, it's just, a developer is really very simple-minded.
Yeah.
Okay, first of all, he's a kind of a one-trick pony, and as long as he gets the land, gets the funding, and gets the permit to start construction, it's a go.
Yeah.
Okay. So, and that's, I would say, probably true for the majority of the developers. So initially, obviously, everybody wants to make a profit, but also developers are very fee oriented. And depending on where we are in the cycle, sometimes a developer knows that there's not going to be a lot of profit in for them. But in the meantime, they need to keep the doors open, and so they do it for fees, with a hope certificate.
So really, who's ultimately the equity behind developers, and how does that differ from like the institutional guys that buy and operate, completed product?
On the big new deals, it is really mainly institutional driven.
So they'll participate both in existing product as well as ground up? The institutions, well, that is?
Yeah. So basically, I mean, that goes into the bucket. So a development deal is typically categorized as a opportunity with a little bit more risk. And so it typically goes in an opportunity fund that requires, higher returns because of the, construction risk, the lease-up risk, I mean, all those things. So an institution can invest in a deal and, probably expect returns of, right now, probably high teens. It used to be like in the mid-20s. That's what everybody was shooting for. But given where construction costs are today and where you can exit, it's probably more safer to say it's like mid-teens to high teens.
What are most of the institutional buyers looking for as far as returns when they go buy a core or core plus deal? And maybe, first off, what's a core and core plus deal? I know we kind of talked about that.
That's a good question.
That's okay. So a core deal, to me, can be pretty much two things. One would be where a core deal has a certain core return. That means it's a fairly low risk-adjusted return. So you buy a trophy piece of real estate in a great location, and it's very safe because let's just say it's a building, that's sitting right across from Central Park in New York.
Yeah.
And the likelihood that that building will de-lease or, be empty is just not very high.
Yeah.
But on the other hand, you also do not expect that your rents are going to grow, 5 or 8% per year. Is basically kind of like it's 2 or 3% rent growth over time. But you can count on a certain cash on cash or a certain return for a long, long time.
Okay.
So location is one thing, and then return is the other thing. So as I just said, certain institutional buyers wouldn't buy in the suburbs.
Yeah.
So a core deal would be more located in the urban core. A core plus deal is a similar deal that's either high quality, located in a good location, but has a little bit of upside. Mm-hmm. So where they can buy a newer product, let's just say it's 5 years old, and there's you can put a backsplash in, or you can just move the needle a little bit by doing some minor improvements. So instead of, let's just say, a value add deal in the 80s where you would have to put 10,000 to 15,000 per unit in it to kind of get, to improve it. Here we're talking about maybe 2,500 per unit or something like that.
Yeah.
So minor stuff.
So then the returns that these institutions are looking for, you said on the development, are kind of at this point in time, and as we finish out 2018, the high teens on an IRR basis. What were kind of the return objectives that you've seen, kind of the core plus? What are those expectations today? They
have come down a bit. I would say on a core deal, unlevered, it would be kind of a 6, and then on a core plus deal, so unlevered 6 for a core deal, and then I would say probably around 11, 12 for levered. Wow. So they have come down a little bit, and on a core plus deal, you're probably looking more like 13, 14 levered.
Yeah, so that's your average annualized return. So yeah, okay. And then as far as we talked a little bit about development too, and the kind of the risk that is inherent with it, from site selection to leasing it to building it, leasing it, and you have some economic risks over the time period. What is like a timeline that a developer generally looks at today from the time they buy that site, assuming it's entitled, to the time they're fully stabilized? What kind of time are they looking at to get that thing turned around so it's in a position for you to go market it to sell?
Yeah, typically the deal size of the new projects is pretty much plus or minus 300 units. So it takes a developer typically about plus or minus 18 months to build it, depending on the type of development, whether it's a garden deal or whether it's an urban deal like a 4-story wrap. In a garden deal, they can deliver building by building. In a 4-story wrap, you go pretty much life safety section by life safety section. But my point is, a garden deal can be delivered, after 12 months, the first building. They typically like to get the leasing office open and then go building by building. A 4-story wrap takes pretty much 18 months or more. And then obviously, there's a little bit of pre-leasing going on before the first units come online. Then it takes them pretty much a year to lease this thing up and get to stabilization. And what's important to us is, like, at the beginning of the cycle, we were able to take deals out when they were like, 80, 85% lease, because we knew that they're going to basically jump across the 90% real quick. Today, we can't do that anymore. And the other thing is also, we don't want to take a deal out that is stabilized or just stabilized, but the net rental collections, for example, have not caught up yet, because there's obviously concessions in there. And the reason why that's important, net rental collections are important, and Paul, you can speak to this, because that is the most important thing for debt underwriting. And a lot of these buyers for new deals, they don't need a lot of leverage. I mean, they're trying to be pretty much between 60 and 65%. But a lot of these new deals, because of the concessions in the market and the rent growth, they don't underwrite very well for debt. So sometimes we struggle a little bit even to get to 60% LTV. And that makes it very tough, because then the math doesn't work for the box that these investors are trying to put these deals in.
So for a garden deal, you said it's about 12 months to build from the time they put the first shovel in the ground, about 12 months to lease up. And then you said for like wrap, structured parking with 4 stories and elevators and up, it's more like 18 months to build and about 12 months to lease up, give or take. So it's 24 to 30 months, depending on what it is. What's kind of the ramp up time from this time they decide to do the project to actually putting, shovel in the ground and start going?
I would say it's about 6 to 9 months.
So we're anywhere from 30 to 40, 45 months from the time. So that's the risk of the deal, right?
So a developer doesn't typically, there's developers that can take down a site without basically having anything lined up, or they have the cash to buy the site and then just go through the pre-development process and basically start breaking ground 6 or 9 months later, depending on how long that takes, which is oftentimes a function of how easy the municipalities are to work with. Most developers don't like to do that. They tie up a site and go through the pre-development process, get their plans done, and by the time they're ready, they close on the site with the construction loan, and the equity comes in first and then go.
But why they have the deals tied up, the developers fronting hundreds of thousands of dollars in architectural fees and permitting and all that, right?
Yes. So basically, the architectural plans alone are going to be $400,000 to $500,000 with interior and architecture. I would say probably on average, a developer has spent $700,000 to $800,000 before he even puts the shovel in the ground.
Yeah. So that's important to know, that's the risk that the developer fronts before the equity comes in, right?
And if the deal doesn't make, that money's gone.
Yeah. Yeah, that's a riskier business for sure. So maybe we take a little bit of time as we kind of transition to wrap up the podcast here. Just kind of talk a little bit about the state of the market as you see it. So what are you seeing right now as we kind of wrap up 2018? How is 2018 and reality as compared to what you thought when the year started? What are some of the things that were what you expected and what's different?
Well, first of all, the market fundamentally, especially here in North Texas, is extremely strong. We continue to create hundreds of thousands of jobs. And in the last 12 months, actually, right now the number is 108,000 jobs. Our population continues to grow. So we're now at 7.5 million in the Metroplex. In 2030, we're going to be at 9 million. So those fundamental markers are just, I don't see any reason why they would change.
Yeah.
So our biggest headwind here in Dallas is our new supply right now. And actually going into 2018, the year seemed to be starting very strong. We had several deals lined up, new construction deals that we took in the market, and it looked very promising. But I can tell you from my own experience that a lot of these deals didn't make because the performance was just not there. The net rental collections weren't there, or the underwriting, was just too discriminating to a certain point, and especially when it comes to concessions. So that our biggest issue right now is, as long as we're having this big new supply in the pipeline, which we're eating through, the buyers don't underwrite a lot of rent growth.
Yeah.
And that way you can make your IRR calculations work. If you don't have any rent growth in your first 2 years, then how are you ever going to make that up? And that's what we're struggling with. And then sometimes the loan proceeds come in too short. You have to put too much equity in the deal, and it's just there's a negative drag on the returns.
And is there like pockets where that's more of an issue here locally? Being a lot of people here invest in Dallas Fort Worth.
It's very simple. It would be great if the new supply was spread evenly across the Metroplex, but that's not the case. Yeah. So as you can imagine, most of the new supply concentrates in the big employment areas. So that's uptown and downtown Dallas. That's where we have the highest supply numbers. Then obviously, our Metroplex grows most in the north, which is Plano, Legacy, and Frisco. So you have a lot of new supply in Frisco and Allen, McKinney in that pocket. Then along the Richardson corridor, the telecom corridor, and then in town Fort Worth. So a lot of new supply in that market. Las Colinas actually has a lot of new supply, but has held up surprisingly well. I think that this time around, with all the great development that's going on and the new restaurants coming, the urban center in Las Colinas is really rounding itself out. Yeah. And everybody I talked to basically said they're very happy with the performance in Las Colinas.
And so if you're selling a garden-style deal or wrap deal in suburban Fort Worth, for example, not in town, that's a much easier deal to deliver and execute on today than something in uptown Dallas, right?
It is. And when people ask me, what should I invest in? Where should I look? The first, answer is workforce housing. And the second answer is go where there's no new supply.
Yeah.
So, and those areas are pretty much, North Fort Worth has not experienced as much new supply. And the other factor is also good school districts.
Oh.
So Mansfield has been actually pretty good, also has good schools. And then I think certain submarkets like Louisville, they benefit from all the stuff that's going on in Legacy with those corporate relocations, but they have not as much new supply.
Yeah.
So the performance is just a lot better. And they're easier. Performance is everything at this point.
Yeah. And then what's your crystal ball telling you guys for 2019? Where are you guys kind of seeing the market go in 2019?
Well, I think 2019 will be a little bit more of the same. because we are still eating through that new supply. By the way, all these new units, they are getting absorbed. The issue is that, these developers are competing with the same product at the same time in the same locations.
Yeah.
But surprisingly, they're all filling up. There's no question that we need more housing in DFW, and that bodes very well for workforce housing.
Yeah.
It's just that a developer cannot build, or it's very hard to build an affordable product.
Yeah.
Because 80% of the construction materials are wood, concrete. It is what it is in order to build a box.
Yeah.
And the much smaller percentages in the finishes or maybe the amenities. And in order to compete in the market, you got to have the amenities. So people say, I'm building workforce housing. It's almost impossible to do unless you go into areas where the land is cheaper and you basically strip your deal of finishes and amenities to meet a different buyer.
And then
renter for them.
What's like delivery? What did we deliver in Dallas-Fort Worth in 2018? I know they were coming in the year where they're talking nearly 30,000 units we're going to deliver.
Well, we have overall 50,000 units in the pipeline. I think in 2018 we have delivered pretty much 25. So we have another 25 to go, and that doesn't include the ones that are being made at this point in time, so that we're in the planning phase. But there's no question that the growth of new supply is dwindling because the numbers don't work anymore. Developers cannot make the numbers work. The costs are too high. The land cost is too high. And so they can't find the equity. However, there are some institutional players that are investing heavily in new developments. And I think what they're thinking is it's better for me to invest in a new deal and get like a 6.5% return on cost instead of having to buy at a 5 or below 5 cap rate.
Yeah.
How much money is coming from overseas versus being domestic?
That's a very good question, Paul. And that's one of the reasons why I like JLL, because we do have the international platform. We have 80 offices across the globe, and we do have people sitting overseas that are talking to investors on a daily basis. So if we have a deal, for example, I can expose that deal internationally. It would have to be a certain size. Unfortunately, a $10 million deal, I cannot take overseas because we need to be more selective, and we're trying to kind of market the big deals.
Sure.
But there's more and more international capital coming to the United States in general, but also now coming to our markets, like, what they would probably consider Dallas-Fort Worth a secondary market, because the primary market is New York, San Francisco, Chicago, LA. So we're now just getting interesting for those guys.
Yep.
And there's more and more capital coming, which is going to be significant for the institutional world.
Having everything be equal, if you're building a brand new apartment complex these days, price being the same, square footage being the same, it becomes down to the quality of amenities. What is some of the craziest amenities that you're starting to see some of these properties compete on?
Well, obviously the number one amenity in every deal is still the pool in our world here in the southern United States. But I do see some very interesting amenities. Obviously, then, the dog component is a big component where with the dog washing stations and all that stuff. But it goes further now where developers are installing golf, like those artificial golf simulators and stuff like that are, one of those things alone costs like $100,000.
Wow.
But it's kind of cool because you can have you don't have to go to a golf course. You can have a little party around it and stuff like that. So those are they're getting out there.
I've seen some wacky stuff that's being offered these days, from water massages. I think Jorg, you had a property that had a water massage on the property.
That's right, and it's being used quite a bit. Yeah, you have to make a reservation, through an app or through the leasing center, but it's continuously, regularly used.
Yeah, and technology is becoming more and more of a thing that's incorporated in the new development with the smart thermostats and package locker systems and all that being kind of a given at this point in all the new developments. And they're even going further. I know I saw some stuff that one of the properties that to get access to anything, they'll use your fingerprint or facial recognition to get access to the amenities 24 hours a day. It's pretty...
Yeah, technology is making its way more and more into those developments. Locking system safety is a big deal. But developers are making those kind of investments because it resonates with the renter, especially those millennials. So we will see a lot more of that happening. At the end of the day, though, most of these apartment complexes are competing with the same amenities, let's just say in Uptown or whatever. And it really boils down more to what are the services, how good is your management, how far from work. It's about convenience because it's really hard to differentiate yourself with more amenities because everybody really goes all out.
Yeah. And so you're seeing 2019, you said we had about 25,000 units delivered in Dallas-Fort Worth in 18. It'll be a little less than that in 19, and then 20 and forward should be tighter.
I'm hopeful that, in basically at the end of 2019, or that as we are selling deals in 2019, people will already underwrite, more rent growth for 2020 because of the new supply just being absorbed.
Yeah.
And there's different groups within the food group itself. So, we talked about workforce housing as being a big thing, but the senior housing, the student housing, everything that comes in. But it seems like that within this group, I don't know if it's workforce housing, but it's really high-end people that can expend $2 or $2.50 a square foot in rents. What's the next group coming after this? What do you see?
Well, the rent number is just a function of the cost. So with land getting more expensive, construction costs getting higher, the developer has to have a higher rent in order to make the numbers work.
Right.
It's not that they just want to have higher rents. They would love to, lease their units at a lower rent, but that means they would have to have a lower cost.
Yeah.
So that's what they're struggling with. What the basis of a lot of deals today is just so high, like a 4-story ramp, for example. You're pretty much looking at 170 to 180,000 per unit.
Development cost?
Development cost.
So
in order to sell that deal, you basically need to be like at 220 exit price per unit. And that's right now where we're struggling. We've had some outliers there in Uptown. We sold a deal for 275,000 a unit, but those are very, very rare. And right now in the overall Metroplex, we're having a little bit of a threshold at 200,000 per unit. And so that's where we're at the point where the disconnect is happening.
And so these developers, are they just getting wiped out by their equity, and the equity's taking the deal and refinancing it and just going to say, hey, I'm going to own this thing for a few more years and wait to get my number?
Not necessarily wiped out, but there's typically the model is of a developer, you get a 65% construction loan, 35% is equity, and the developer typically participates with about 10% in that equity. The rest comes from an institutional investor, which takes care of the other 90%. The 90% limited partner investor is not necessarily kicking the developer out, but at some point in time, the developer, is kind of getting eaten up in the process because the institutional investor or whatever has a certain preferred return, and the developer is supposed to make his money on the promote. That's why they basically, they build it, they lease it, they sell it. Mm-hmm. And when you can't sell it, that's when the developer is at a disadvantage. Yeah. Now, the developer can still get his money out in a certain return on his money, but there's not much on top of that.
That's good. So that's why Paul's always banging the table against the preferred return. So when at all possible, as a sponsor, it's not, it has a tendency to disalign interests sometimes between the equity and the sponsor of the deal. So anyways, Paul, anything else?
If somebody wanted to get in touch with you, what's the best way for somebody to get to know you a little bit better, Jorg?
Just give me a call.
Okay, let's throw it out there. What's your email address and what's your telephone number?
My phone number is 214-438-6561. And my email address is jorg.mast@am.jll.com. And my first name is spelled Jorg.
So Jorg is probably one of the smartest guys that we've had on the podcast because he uses both hands. Not only was he a developer and understands how these transactions get put together on the development side, but also too he knows how to sell these properties after they've been completed to institutional buyers or even workforce housing or even guys like Mike.
Yep. We bought a deal from Jorg earlier this year, so it was
a great transaction.
It was a great
Loved
transaction.
working with Mike.
Yeah, it was a good transaction. So, anyways, recommend you guys reach out to Jorg if you guys have any interest. They like you said, they do both the institutional stuff, and they have a pretty robust workforce housing group here in Dallas-Fort Worth, as well as the other major Texas markets.
Yeah, he would be the point of contact if you're looking even to buy a property in the Dallas-Fort Worth, Texas area, but also on the international side too, because as he mentioned, he has a little bit of a Northeast Texas
accent.
Southeast Texas accent.
So we appreciate Jorg Mast being in the podcast. Michael Becker, thanks for hanging out with us.
Yeah.
I'm Paul Peebles. Have a great day.
Thanks for having me.
All right. Thanks, bud. Bye-bye.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.